Miss Mio, in China there are so-called A shares and also H shares. You recently launched a fund focusing on the A shares. What makes them interesting for Swiss investors?
Okay, so when we talk about A share, those are shares that are listed in domestic China A share markets. There's several characteristics that make them very interesting. First of all, it is a market with a lot of retail investor participation, and in that kind of markets, in general, it is very inefficient. Therefore, there will be a lot of alpha opportunity for investor. And second is because of the capital control, China's Asia market is totally uncorrelated or very little correlation with the international equity markets. So for investor, it provides a chance to diversify.
If you have a look at the different sectors, what would you say are the interesting sectors right now in the Chinese stock market?
When we invest, we like to take a thematic approach. We identify long-term investment opportunities in several themes. So far, what we think that has the most potential are themes like consumption upgrade, technology and innovation, and structural reforms. And after we identify this theme, then we look for the best stock that can represent these themes.
If you look at the internet tech firms in China, they're all not listed in the A-share section, but they seem to be growing really fast. What potential do you think those shares or this sector has?
Okay, in the past, the internet sector actually grow because of the continued growth in the internet users. And right now, actually, internet user already reach a very high level, close to 65–75% penetration. But what we're seeing is continued penetration into the rural areas and also the penetration of using smartphone. With the proliferation of smartphone, there has been a lot of growth in mobile internet. And with mobile internet, it enables a number of applications. For example, social networking, e-commerce, and then also mobile games. We still see a substantial growth in this area. And particularly with the deployment of AI, these companies continue to provide better service and higher value added service to consumer, and therefore they are still experiencing very high growth.
In October, Xi Jinping has been re-elected as the Communist Party leader for another 5 years, but he promised economic reforms. What does this mean for the future economic growth in China?
The presidency actually emphasized now the growth going forward will change from high-speed growth to quality growth. When we're talking about quality growth, what it means is the level of growth. Basically, President Xi set new targets in terms of when we reach middle income level and when we reach the high advanced income level. Now the goal is by 2035, it will reach close to middle income level, and by 2050, reach the advanced economy level. And that means going in the next 10 years or so, we will still be in the moderate level of growth or moderate high growth, about 5 to 6%, and then maybe in the next 20–30 years, around the level of 4 to 5%. But that is not the most important thing. The most important thing is the word quality. So what it means by quality? It is a better a growth that can protect the environment, a growth that makes people's life better, and also make the use of technology in promoting more efficient growth.
But China also has huge debt levels, and there's also risk of a property bubble burst. Are you worried about those developments?
Okay, these two are really the concern of a lot of international investors. First, let me talk about the debt level. Sure, now the total debt to GDP is close to 270, 280%. It is high in international level, but it is very similar to some of the advanced economy. One thing that makes us comfortable with these is that majority of these, close to 90% of these debt are financed domestically by domestic deposits. Take for the example of Japan, their total debt to GDP is already now 450%, but they have not collapsed because all or majority of this debt is financed domestically, and therefore it can sustain for a long time. In the case of China, another thing that makes us feel comfortable is because a lot of this debt are debt from the state-owned companies, and normally it is backed up by the government. And the Chinese government, different from other governments, is that it owns a lot of state-owned companies, and these are assets that can be liquidated, that can be sold to turn into money and repay the debt. In terms of the property bubble, in China, it has several different types of cities, what we call tier 1 cities, tier 2, tier 3 and 4, etc. What we see, if we divide them into different levels, then we find out that the tier 1 cities are the ones that experience very strong property bubbles, where property price to income has rise dramatically. But when we look at the tier 3, tier 4 cities, which is majority of China, that the property price to income ratio is actually quite reasonable. So we are not as concerned about property bubble in China.
Ms. Miao, thank you very much.